Silver took a while to get to new highs, but it's finally at all-time highs, as well as gold. And I think now there's clear sailing for both of them.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 17th through November 24th, 2025, while supplies last. First this week, backdated 1-ounce gold buffalo are just $320 over spot per ounce. Next, pre-1933 MS63 $20 Liberty coins are just $150 over melt per coin. And finally, 1-ounce 2025 Silver Eagles are just $7.85 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend David Hunter, a contrarian macro strategist with over 50 years on Wall Street. We were talking about before the interview that you think we're at an inflection point right now, as we're seeing, it seems like everything continued to hit all-time highs over the last couple months, precious metals included, the stock market. Your take on where we are right now?
Yeah, I think obviously we've had in the last few weeks this pullback, and it's kind of the pause that refreshes. We've seen them before. Obviously, we had a bigger one back in April. This is more of a truly a pause that refreshes. It gets everybody concerned. Everybody's talking about the bubble in AI and whether the market has topped and whether trouble ahead. And basically, you've rebuilt the wall of worry. I think there's always a possibility of going lower, but I think we may have seen lows of this pullback. You know, the S&P pulled back about 5% almost precisely. And I think we're probably off to the races here. I think, it's not that it'll be up every day or that it's going to be straight up without any more pullbacks, but I think between now and the end of the year, you could have a very strong rally, certainly between now and Thanksgiving is a traditional seasonal strength time. And I think we're going to see that here. Everything to me looks as it has, ever since the last time we talked. We're moving to new highs. Every time we get a little bit of a sell-off, people start, jumping back out saying, oh, the top is in. It just tells you still have, surprisingly, as far as this market has come, you still have sentiment pretty much restrained here, if not, for many people, downright bearish, but I think for others, at least, not a bullion.
That's very interesting. It does seem like there's a lot of caution in the markets right now, even on the mainstream, kind of people talking about things being overvalued. So as you mentioned, it seems like that would probably not be a signal of a market top if everyone is kind of thinking the same thing.
Yeah, definitely. And I think people always use valuation and get nervous, but frankly, valuation's never been a good indicator of a top. Certainly we're, as I keep saying, we're 43 years into a secular bull market at all-time highs or very near all-time highs. We've been very strong since October 2022, more than doubling off of that. So it's, it's understandable that valuations are higher, and with what's going on in AI, that certainly has lifted things. But if you look below that and look at a lot of other stocks, there's plenty of areas in the market that are not overvalued at all. And frankly, as I said, valuation is not a good indicator of a top anyway. So even the things that may seem a bit up on stilts, even they look like they can go a lot higher. So it's funny, but particularly on the institutional side, all the way up from October 2022, so 3 years out, we still have people with 1 foot out the door. I mean, the portfolio managers, yes, they need to be invested. Yes, they're going with the momentum when it's up. But every time things start getting a little bit negative, they get cautious again. And that's a sign that we're not near our top yet. I think time-wise, we're not that far away. Could be just a matter of months. But from a standpoint of how far this thing can still run, to me, there's just still a big wall of worry that can fuel a much higher advance.
No, some of the concern in the markets and also the precious metal markets, it seems like stemmed from this idea that the Fed might not cut rates in December. Your perspective on that, and how is Fed policy here going to dictate what the markets do next?
Yeah, no question. The Fed seems to be, along with the worry about an AI bubble, the Fed seems to be, right front and center in terms of the thing everybody's most concerned about. It's funny because on one hand, I think the Fed is going to help fuel this run to the top, and I still think there's 40% plus to go. But on the other hand, it doesn't mean it has to, that if they don't cut in December, it's all over. I mean, people get a little too, I think, too obsessed with the Fed, frankly. And maybe even our president is doing that. But as I say, the bond market will dictate rates. And my look at the bond market tells me there's a big decline in rates coming. Doesn't mean it's right from here, but I think somewhere between we're 410 or thereabouts, between 410 and 420 on the 10-year is, I think, the end of this backup in rates. And I think you'll see 3% probably in a matter of a few months.
There would be a dramatic decline from here. Your perspective then on not just what the stock market is going to be doing, but what precious metals are doing as well. We had kind of a shakeout in the last couple weeks here, or I guess you could say last month, when we hit all-time highs in both gold and silver, and then a huge pullback, about 10% or so. Your perspective on where precious metals go from here?
Yeah, it's been a tremendous run this year. The miners have finally started to catch up to the metals. Gold's done very well, as we know. It's has been up to 4,400, I think. And silver, which had lagged, has done a lot of catch up in the last several months. We've gone through a correction here. You got a lot of people calling for lower prices on gold and silver, lower prices on the metals. My look at it is that we are at that inflection point here too. I think as of today, you may have bottomed out in the miners, and I think there's a big run ahead. I think the biggest part of the run in the miners is ahead. As big as, some of those have doubled and tripled off their bottom, some more than that. And yet I still think the biggest move is ahead of us, and ahead of us in the next 6 months. It's not, 2 years ahead, 3 years ahead. They will get hit in a global bust, which is what I'm expecting after this, sometime next year. But before that, there's big upside in the miners. My target on gold, was 5,000. That's where but I think that may prove conservative. I raised my target back in early October in my fourth quarter letter on silver. I raised that to $100 from 75. And I'm pretty confident we're going to see that in the next, several months. So there's basically silver took a while to get to new highs, but it's finally at all-time highs, as well as gold. And I think now there's clear sailing for both of them.
No, kind of just to reiterate what you've also said on our show in the past, your kind of long-term outlook here is that we're going to see this melt up, a huge crash and a bust, and then a final, inflationary period where, all assets kind of go ballistic from there. So, and I know you don't offer trading advice or anything like that, but when it comes to market timing, which is so difficult to do, in this blow off top, or in this melt up that you see happening in the next couple months, what are some of the things that you're going to be looking at that would signal, we might be kind of nearing a top, and people might consider, loosening up their positions a bit?
Yeah. So just to kind of clarify, I am looking for a top in a 43-year secular bull market. So this is what would be categorized as a very major top. and one that will probably stand for decades. So the highs in this stock market I'm calling for, which I kind of glossed over, but I'm calling for 9,500 now for the S&P. I think last time we talked, I was down at 8,700. So I've raised that in my fourth quarter letter to 9,500. That's a long way from here. It's 40%, probably from here, basically. And the NASDAQ I raised to 32,000. The Russell I raised to 3,800. And the Dow I raised to 65,000. So all of them have basically 40% plus returns from here to go. With that in mind, it's not a top yet, and even though it can come very fast in this final stage, you don't want to get nervous yet and jump out. But on the other hand, time-wise, we could be at a top as early as sometime in the first quarter. And so you do have to start looking. And what I will say is that we're not seeing the signs here yet, but what I would be looking for is sentiment to be all in. Once you have, as I said, people are pretty cautious right now, and every time we get a little sell-off, they get nervous. Once you have everybody convinced, we got the Fed at our back, the Fed's getting more aggressive and easing. It means the cycle has a long ways to go. It could last for a couple more years. Once you start hearing that rhetoric, that's the beginning of the end. It's not the end, but it's the beginning of having to start say, how long can this run? I don't think it has 2 years to run. I think it has months to run. I may be wrong. It may get stretched out again. But that's what I would be looking for, is sentiment to move from this kind of semi-bearish, cautious area to where everybody's convinced that everything's wonderful. And I think that's coming. It's that kind of what we see at tops. We haven't seen that in this cycle yet. I also think that you'll begin to see a much weaker economy. And that's, I think, will help fuel this last run, is as the economy weakens, the Fed's going to get more aggressive on the easing side. They have to start pumping liquidity because they've been too restrictive. And that will initially be taken as a positive for the market. But as the economy continues to weaken, I don't think the Fed's going to be easing aggressively enough to stop what I think is going to be a pretty dire 2026. So that's what I would start thinking about. And you mentioned market timing. Again, I've talked about this in a few of my interviews. From the mid 80s on, the mantra in terms of what the financial industry pushes on the investor is it's time in the market, not timing the market. I would just caution people, that has been great advice. Anybody that just kept putting money into an index fund for the last 30, 40 years has been very thankful of that, and just stayed with, if they stayed with it, has made a lot of money. There comes a time when a cycle comes to an end, a big cycle comes to an end. I'm not talking about the shorter economic cycles, but a bigger market cycle comes to an end. And when it does, and if I'm right that this one's going to be a major top where you could see as much as an 80% decline in the stock market, you don't want to ride that down. So even though, the advice of just buy and hold and markets always go to new highs has worked wonderfully for, as I said, for 40 years, is not going to work well for the next decade, because you're going to get hit very hard if this thing does what I think it's going to do. And then you're going to have to dig yourself out of a big hole, and you may not get back to the levels you were at this year or early next year. So it is a time when you may have to kind of go against what's conventional wisdom right now in terms of buy and hold, and say, I'm going to be out. It doesn't mean you have to be perfect and when you get out, but you're going to have a better entry point, I think, probably end of next year or early 2027. And it will be a different market cycle following this one. Every market cycle has different leadership. This one was led by tech. to some extent healthcare earlier in the cycle. The next cycle is going to be much more an inflation-driven cycle, led by the commodities, led by the precious metals. So, yeah, you can ride the metals through this, but they're going to get hit too in a bust. In a global bust, most assets are going to get hit. But whereas, say, the stock market might drop 80%, gold might drop 50% or 40%. So it will be a relative performer, but there's still a big hit. So the things that will hold up in the bust will be pretty much treasuries and cash.
It seems like the people holding kind of the traditional portfolio, I mean, I guess there's bonds in there, right? So those might not do terribly if they have treasuries, but it seems like the general public is really ill prepared for what's coming, is what you're saying.
Yeah, because it's, a strategy that's worked for so long has gained a lot of acceptance. So it's going to take a real mindset change to go from, well, I just let my portfolio ride because it always comes back. Yes, we have these periods of time that are negative, but I'm not smart enough to time it, so I'm just going to stay put. That's been the conventional wisdom for a long time now. It's going to be very hard to convince people to go against that because it's worked so well. And yet that's probably what they should do.
If we look at a situation like in Japan, right, it took, was it 4 decades for the Nikkei to finally make new all-time highs, or even more than that? What kind of time frame do you anticipate? And I guess important to note here, maybe all-time real highs, right? Because we're probably going to go into a massive inflationary period after the bust. So just if we make new nominal highs doesn't mean, people have benefited or are up truly.
Yeah, like I said, it'll be decades. I don't know whether it's 2 decades, 3 or 4 or more, but I'm pretty sure because of what's coming. It doesn't mean all things are not going to be up at new highs, but the broad indexes, the S&P, the Dow, the NASDAQ, those indexes, I think, are going to be decades before you see the highs that you see in this cycle. So if it's 9,500 on the S&P and you go down 80%, let's round the number. Let's say it's 10,000 on the S&P. You go down 80%, that's 2,000. You can come out of the bottom of this bear market and see the market triple or quadruple off that bottom. So it could go from 2 to 6,000 or 2,000 to 8,000 and still be far below the peaks of this cycle. So it doesn't mean you won't have a cyclical bull market or a money-making opportunity in the indexes. But if you ride it all the way down, that's not going to get you back to even. You're still going to be well below even, I think. Whereas if you're in a more narrow group of stocks that are, let's say, commodities, the next cycle, those could go on to major new highs. So, I'm calling for gold to go to 20,000. I'm calling for silver to go to 500. So even if you rode through the bear and rode through the bust and bought and held, those things you will be fine. You'll just have to deal with the negative period that you won't feel very good. Your portfolio's gone down, but so it really makes a big difference what you're owning going into the bust, and then what you're owning on the other side of it. In terms of, but I do want to stress, people hear dire things like 80% and never getting back to those highs or not for decades. That does not mean there's not investment opportunities in the next several years. There's going to be some very big opportunities. It's just going to be in a different manner. You're going to have to kind of adjust to the different kind of a cycle that you're going to be in, because it is going to be, what happens is in the bust, the central banks around the world are going to have to respond to the bust with all kinds of money. So similar to 2020, similar to 2008-9, you're going to see massive money, except I think it's going to be 4 times what we saw in 2020. So massive money. It will trigger a rebound. It will trigger a recovery cycle. It will trigger a new cyclical bull market. but it also will trigger an inflation cycle, the likes of which we haven't seen in this country. So if in the early 80s we got up to the 20% inflation, I think this time around we might get up to 25% inflation by the early 2030s. If you see that, that's going to be negative for a lot of growth stocks. So stocks that depend on lower interest rates, it's going to be negative for the bond market. I personally, I think you're going to have a great run in bonds. You could see a 0% 10-year at the end of the bust. But from there, you could see the 10-year go to above 15%, maybe even 20% over the ensuing 7 or 8 years, 6, 7, 8 years. So I personally would consider that 0% 10-year, the top of the bond market, probably that will be the top and the bottom in rates for a long time to come as well. So if you think it through, that means the next cycle, bonds are not going to be a good investment. If the indexes are going to be lagging, they're not going to be a great place to be. And so it starts putting you more towards commodity. And it doesn't just mean gold and silver. It means oil stocks, copper stocks, steel stocks, all the commodities I think will do very well in the next cycle. So it means you, and that's investments if you go all the way back. Every cycle you'd have to be flexible. And what happens to most investors, because they don't understand that, is they kind of ride with the horse that brought them there. And so they don't really change things around. And then the next cycle, the things that worked so well in the past cycle are the laggards this cycle because they're under a lot of distribution. And the things that are the new leaders are the lowest weighted things in the indexes. So they don't really give you the oomph that you want. You have the heaviest weighting things are from the past cycle, and those are laggards, and the lower weighted things are the new leaders. So you have to kind of be a more active manager going into the next cycle is what I'm basically saying.
Now, what are your thoughts on how this could, I guess, change, for example, like the disparities between the rich and poor in this cycle? Because it seems like at the moment in the last couple of years, when we've seen high inflation and then we were hit by, high interest rates, it's the lower income people who are most affected by both of those, right? And people are getting priced out of housing at the moment, right? In the middle class, it's hard to even afford a house. So what is your anticipation? Do you think that disparity will just get worse going forward? Your take on that?
Yeah, it probably will be lessened some because the top end are going to get hard, but they have more to be resilient with. The guys that are struggling now are going to continue to struggle because in the downturn, because downturn hits everybody and it hits the poor the hardest because they don't have the wherewithal. Longer term, I think you are going to see the gap close somewhat because think about it. If the market's down a lot, who's that hit the hardest? It hits the high end. If real estate gets hit, and I think home prices in the U.S. could drop 30 to 40% in the next 2 years, that's going to hit those that have the home equity and are feeling somewhat like they have some wealth the hardest. So you close that gap, but it doesn't mean the other people are gaining. They may be not losing as much, but so the gap's closing, but they're not feeling better. However, and it's what I say all the time is we're coming into some very hard times. If you get this kind of a scenario where the market gets hit hard, home prices get hit hard, the economy is going to be facing inflation. And then after that, I think even a depression in the mid 2030s, the best thing you can do is not get yourself caught up in debt. Try to reduce your debt. Try to take advantage of these changes in the markets where you can get into the things that are going to work, and try to get your financial house in order to be able to withstand what I think are going to be tough times. I will say the Trump administration is trying to bring back middle America. I mean, it's been 40 years of very bad policies. A lot of it was the whole comparative economics theory of, send your manufacturing out to the places where you can do it cheapest, because whoever can do it cheapest, that's okay, and then you make your money here on Wall Street, etc. Well, that really benefited Wall Street. The corporate earnings went up, but it gutted our middle class. It gutted our middle America. And a lot of these cities are burned out cities that are, very drug infested and crime infested, because people lost hope. And so Trump is trying, through tariffs and through these other deals, trying to bring capital back into this country from foreign investors. He's trying to rebuild that as fast as he can. And that's where a lot of the criticism is people see what he's doing. It looks reckless or looks a little chaotic, but that's what happens when you have to do it quickly. We don't have the luxury of decades to do this, which is how it would normally play out if you reverse things. He's trying to do it faster. I think it's the right policy. Hopefully the Supreme Court allows the tariffs to proceed. We'll see. But people need to be patient, because it doesn't happen overnight, even if he is doing it quicker than anybody else could do it. But that is the goal, is to try to level the playing field, bring back Main Street somewhat at the expense of Wall Street. He's not trying to hurt Wall Street, but they've had great time. That's why we've got a 43-year secular bull market. But Main Street's really suffered, and it's been both Democrats and Republicans have allowed this on their watch for decade after decade. And basically it was the economic theory out there that comparative economics works. If the whole globe benefits from going to the lowest cost producer, then that's what we should do. And unfortunately, that's not how it worked. And of course, there's it's also not a pure economic model out there. You had China doing what they're doing, and others doing what they do, and but we've been the marketplace to the world, and it's time to kind of reverse some of that. Get the trading deficit down, get manufacturing back here, and that I think is going to be part of the next cycle. Is a lot of why commodities are going to play so well is because we are going to see manufacturing resurgence in this country. But that means building new factories, new plants. That requires a lot of steel, a lot of commodities. And unfortunately, we won't have the supply. The demand will outstrip supply, and prices will go through the roof. But if you're there as an investor, you're going to be happy about that.
And our channel is all about being aware and prepared. And I think it's been really helpful to hear your insights today, David. If our viewers are interested in learning more, they can sign up for your newsletter. Can you tell us a bit about that?
Sure. Yeah, I've got a quarterly macro letter that I put out by subscription, so there's a cost to it. Up until now, I've always said just direct message me, and I'll send you details, what it costs and what the letter entails. Unfortunately, X has decided to change what was working fine, the direct messaging function they had. And in the last week, they switched to what they now call chat. It's an encrypted message system. It was rolled out poorly, a lot of problems with it. It's a very laggy system. Unless you put in a passcode, you could send me a message and I can't get back to you because you haven't logged in. So it becomes a very unreliable system. Lots of my messages, I put in a message and it says it didn't go through. So it has really kind of changed things for me, at least, where what I think I'm going to do is ask people to still use that message, still direct message me through that chat, but just direct message me your email address, and I will email you the details of my letter. You can still try it the other way, but if you don't get a response from me, it's because I couldn't get back to you. So I just want people to know I'm not happy with X right now because it really is not a reliable system at this point. They rolled it out. I don't know what kind of beta work they did before, but it is, there's a lot of people out there complaining about it. I will say that.
All right. Well, thank you so much for explaining that. David, once again, thank you so much for your time. And are there any last thoughts you'd like to leave with our viewers, what people should be paying attention to right now?
Yeah, I would just reemphasize, I think we are at a major inflection point. Well, major isn't the word. I think the major inflection point was last April, but we're at a significant inflection point here in terms of the correction, I think, is running its course. It has run its course in both the stock market and the metals market, and that includes the miners. I think it's up from here. And I think bonds will shortly follow. So, we're going to have a period here, I think, over the next 3 or 4 months where bonds will be great, stocks will be great, and the metals will be great. So you'll have it all working.
All right. Well, once again, thank you so much for your time, David. You have a good next quarter, and we'll talk to you again in about 3 months. Thank you so much, and God bless.
Yeah, thanks, Elijah. Happy holidays.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for November 17th through November 24th, 2025, while supplies last. First this week, backdated 1-ounce gold buffalo are just $320 over spot per ounce. Next, pre-1933 MS63 $20 Liberty coins are just $150 over melt per coin. And finally, 1-ounce 2025 Silver Eagles are just $7.85 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.